What hits Monday will crush stocks harder than last week. I'm Steve Van Metre. More chaos is coming, and when you see what's about to slam the markets tomorrow, you want to get out fast. Now, let's over to Bloomberg, where he picked today's story up of the headline. Let's start out what was said by Treasury Secretary Scott Bessent. He said he is defiant on tariffs as he rejects a U.S. recession. Now, it's very clear when you look at what happened to the equity markets last week that there was no thought that there wouldn't be a recession. In fact, the markets are starting to get the idea that it won't be just a recession. There could be something much worse, maybe a financial crisis, maybe a depression. Now, I want to know from you, weigh in the comments, what do you think the markets are saying? Recession, depression, crisis, all of the above? Because let's look further at what he had to say. I see no reason we have to price in a recession, Bessent said. But again, when we look at the reaction of the markets to the tariffs, it's very clear that's what's exactly being priced in. Now, keep in mind, Wall Street didn't think that Trump was going to go all in. They thought he was going to back off. And they didn't think the tariffs were going to be anywhere near as big as they are. And then they thought, well, they're going to come off the board really quickly. And now it's looking like that's not going to happen either. Bessent gave no indication that President Donald Trump was willing to back down on the sweeping new tariffs he introduced last week. He said that more than 50 countries have called the administration seeking negotiation, but any talks are going to take time. And again, everybody thought that this was going to be a quick deal. It was going to hit the boards and get pulled off as country after country started to make a deal. And now the market's starting to realize that this is going to be here for a while and a lot longer than anyone thinks. And this is going to be a huge hit to growth. It's going to cause inflation to go up, and it could hit the labor market. We talked about yesterday how JP Morgan said this is a case for stagflation, the same case we've been making for months. And from the U.S. perspective, other countries have been bad actors for a long time. We're going to have to see what the countries offer and if it's believable. I think we're going to have to see the path forward, again, giving the markets every indication these tariffs are here. They're going to be here for a long time. And even if we make a deal, they may not go away until they're proven that these countries are going to fall in line. And this means we could see on Monday further selling in the market, not just a little bit, could eclipse what we saw on Friday alone. Now let's shift and take a look at the Goldman Sachs flow of funds report, where they say the market has fallen more than 7% since the announcement. And this is bad, and it's really bad because when we look at history, it says that the start of April is the weakest part of the month. And what we see is that flows don't really kick back in, at least historically, until the 9th. And that means we could see further selling early in this week. Not to mention the fact that people are waiting over the weekend. They're looking at what happened. They're looking to the administration to say that everything's going to work out, and right now there's going to be more panic and more chaos. But I'm going to show you why the equity markets could unwind far more than you can even imagine. Let's take a look at CTA positioning, because these are systematic machines. They trade hundreds of billions of dollars and they follow the direction of markets. They're called momentum traders for a reason. So when markets are going up, they're buying, but when markets are going down, they sell. Now, we talked about yesterday how they broke their critical long-term threshold. This meant on Friday, all of that selling was largely at the beginning due to the machines. And now what we're seeing is they are short 24.7 billion in U.S. equities alone. But the problem is they're about to hit the foreign equity markets in a big way. Let's take a look at how they're positioned right now. The S&P 500 shown up here in red, machine position in blue, which suggests if some support can come into the equity markets and hold price up early next week, that the machines would have to come out of those short positions and buy. The risk is if the machines are right here in their positioning and there's more panic, that means they're going to be further selling in the equity markets. And you can see machine positioning fairly neutral here over the long term, meaning it could sell down even more because, as we've talked about, those volatility control funds and risk parity funds, well, they lag the CTAs, meaning they've got a lot more to unwind. But let's take a look, because it's not going to just hit the U.S. equity market, but it's going to really hit foreign equities. Over the next week, Goldman notes that they could be sellers of almost 60 billion in total equities, but only less than 3 billion of that from U.S. equities. Over the next month, 81 billion could be hit and sold by CTAs. And again, a mere 3 billion of that would be U.S. equities, indicating what we could see is mass selling of foreign equities. And right now we've looked at what Wall Street had to say. That's been their safe spot where they've been running to. we said don't go there because look at global positioning of these machines. You can see they're fairly high up, and that means they still have a lot of potential selling that could still hit the boards, and we could see that start to hit next week. But there's another problem. It's called liquidity, and liquidity is how many people are in the market that want to buy that can absorb the outflow. The problem right now is liquidity is drying up and fast, meaning there's far more sellers than there are buyers, and when that happens, well, you get dislocations, particularly to the downside as more people hit the sell button. Again, this is a major warning sign coming from Goldman that early next week could be another bloodbath. But let's talk about the real big reason, because it's everything to do with retail traders, and what they've been doing is taking on massive amounts of leverage. So a lot of people have been looking at the equity market and say, well, it keeps going higher and higher. It must be a great proxy for the economy and what's really going on. But what you've actually seen is retail traders pile on leverage after leverage, and it's forcing markets higher. Now, the risk here is this leverage is going to have to come unwound if we see markets drop, because again, when you take multiples against the market to the upside, well, you lose a lot to the downside. The other issue here, if they bought this on margin with debt, they can get margin called and be forced sellers by the dealers. Here you can see that run up since the pandemic has been largely driven by leverage. And if all this leverage comes unwound at a time that liquidity is drying up and the machines have to be still net sellers here, you could see the stock market all out plunge. But Goldman says, well, do you have faith? Because you might need a miracle here. They say that the normal flow of funds resumes right around April 9th. The question is that likely? Now, I'm going to say I don't think so, because in a normal market, that's what Goldman is looking at. Historicals, we haven't seen the impact of tariffs. Well, not since we go back to the 1920s at this level. So we'll just say that the normal flows of people putting money in the market might dry up pretty quick. And Bank of America actually backs this up by saying, look, we're not even at a buying point. They actually show that their bull bear indicator is just slightly bearish. In fact, if they say if you're looking for a buying opportunity, we're nowhere near that, indicating there could be a massive plunge in equities. Keep in mind, a normal recession, you see a 30% correction. If we see an all-out bear market, potential depression level data, you could see stocks come down 50% to be at the beginning level, if not even more. But if you're looking for an entry point, let's talk about where the markets are set right now. Let's start out with breadth, and we're looking at a long-term chart here. Now, we normally look at a 6-month chart, but I want you to see the historicals of all the data I could pull. And right now we're looking at less than 23% of the S&P 500 trading above its 200-day moving average. Now, historically, when we look at that, it's a -2 standard deviation move. Historically, generally, in a normal economy, this would be a fantastic opportunity to come in and buy, and all you'd have to do is see other buyers coming in. The risk now is we drop to a 3 standard deviation event. You can see that signifies the bottom of the financial crisis, bottom of the dot-com bubble, bottom of the move prior to the 91 recession. That would be a huge buying opportunity. But if the tariffs stay up, we could see things get even worse. I want to know from you, do you think this is just going to be a garden variety recession move, or do you think it could be even worse? Could we get down a 50% or greater move and decline in stocks? I want to know from you. Weigh in the comment. Let's take a look at our screens here, because momentum is negative. We have the RSI at 23. MACD's got a negative cross. Now, if you didn't see this coming, our Momentum Timer Pro program saw 31 consecutive daily sell signals. So if you're trading momentum, our subscribers already knew momentum was a downside. This was their flag to get out. In fact, none of our subscribers were long the U.S. equity market based on our signals going into this big downturn. And we bought machine positioning as well. You can see down here, this is our CTA Timer Pro. It's now suggesting the machines are going to go into a deeper short position, and they're already in a very deep short position. Now, we run historicals over the existing models that the machines run, so we can tell, usually with a high degree of accuracy, if they have more selling or buying to do. In this case, we're modeling more selling. Again, all of our CTA Timer Pro subscribers, they were not long the U.S. equity market based on our signals at all. Let's take a deeper look, because what do we see? Downside target, I'll show you 493.86. We have no position, and we haven't had a position on this. A lot of people said that was silly. Well, I don't think that's silly now. Let's take a look here, because what do we see? Big drops on Thursday, Friday, and now what? Here's your next level support right around 493. There's not a lot of support here. The big support isn't until you get down to around 437 or 450. But keep in mind, if we see a depression level move in the markets, you could see the S&P cut from that all-time high of 613 and drop, if you can believe this, to around 307. Do you believe that could happen? Is that even possible in your mind? I'd love to know from you. Let's continue on and take a look at tech stocks. We see a similar scenario here. This is a case where momentum really doesn't matter because it's all about being in cash, preserving your position, and looking for opportunities to get in. So let's take a look at breadth. What do we see on the NASDAQ? Under 21% above its 200-day moving average. Here we are looking at historicals. Now, typically for tech stocks, we want to see a deeper pullback, somewhere around a -2.5 or 3 deviation here. That's where you get some wonderful bottoms. So we're not there yet. Again, suggesting tech stocks likely to sell off even more. And of course, that's something else I want you to think about. Corporate share buybacks. Now remember, we're still in the blackout period, but earnings reports should be coming soon, and that means companies will be able to buy their stock back. But one of the biggest risks I've said, if there was a condition where corporations said they're going to start holding cash and stop buying their stocks, well, they're the largest buyer of the equity market to begin with. Retail's number 2. Well, retail's over leveraged, and if corporates black out and say, look, we're going to preserve our cash because we're afraid, watch out. There aren't any buyers left in this market, and that is a massive downside risk. Let's take a look at our screens. Again, momentum negative across the board. Our subscribers out on these trades if they had them a long time ago. We told them, let's not trade the broad equity market. Let's look for opportunities elsewhere. And if you want to get in on our training, if you want to know when to buy back in this market, well, our subscribers are going to know first. Grab the links in the description below. You get a free 30-day free trial if you use a coupon code, so you don't even have to put out any money because, again, machines short here, max short, looking to sell more. Let's talk about the downside target, 413. Upside target here, in my opinion, really not a factor when you start to understand there's a lot of leverage, margin, and still machine selling yet to come. What are we targeting here? 413. That means support right around this point here. You see this little chunk of volume. This isn't big. You really need to find support. This is on a 2-year chart, my friends. You're looking at 367. Can we get there? Absolutely. And this would cause a massive amount of pain because if you're trading technicals alone, in bear markets, technicals really don't seem to matter until you get to the bottom. But where will the biggest opportunity be? It's going to be in small caps, may come sooner, or this could sell off so much. The opportunity is going to be massive. I want to show you why. Let's take a look at the percentage of Russell 2000 stocks above the 200-day moving average. It's now 14%. Historically, this is where you get to major buying opportunities. If you want to know, you look at breadth. It gives you the very first indicator. Now, we know it can go worse. It can get under 10%. And then you're talking back in financial crisis level buying opportunities. You're talking about the move down after the financial crisis. It looked like a double dip recession. You're talking about post-pandemic. You're talking about the pullback in 2022. So there's more here to come, but what we're looking at is potential buying opportunities, not to mention bear market rallies can really send stock prices surging. It's all coming down to the tariffs. I want to know, how are you playing this? Are you in it and hedging? Are you in cash looking to buy? Did you get trapped in this market? What are you doing? What are you up to? Weigh in the comments below, because right now momentum's negative, 33 consecutive daily sell signals. We told you, don't go long small caps after the election. A lot of people did. We said this wasn't the trade. Machines are short. Momentum Time Pro, again, 33 consecutive days of selling. Let's take a look at the chart here for IWM, because if I see the first opportunity to get back in, it's going to be in small caps, but I think we got to get down here to this 165 level way over here. See, I don't care about these oversold levels right now. That would matter in a normal market, but support, we may even have to go out to the 5-year chart for you to see it, and now it becomes clear right down here, 160 to 170. There's your major line of support. That's your big supply zone. And if we blow through that, well, now you're talking 150. So this is where we're going to be first watched to see. So this is going to be our first watch to see when to get back into this market. Let's talk about energy. What did we tell you? Don't trade energy. And now what are we finding out? 8 OPEC plus producers are accelerating their crude oil output hikes. Now, what does that mean? Of course, supply hitting the market. When supply hits, what does that mean? Price is going to go down at a time when, if you go into recession, what happens to demand? It goes down. So this is an ugly position for the energy markets. Let's take a look at our screens. Now we have 2 consecutive daily sell signals after a string of buy signals. And we told our subscribers, don't buy these signals. We don't like to set up. Sure enough, paid off big time, protecting their money. Again, momentum now 24 on the RSI, MACD deeply negative. Where do we see this go? Well, maybe down to 75, 73. Let's take a look at the chart of XLE and see what's going on, because one of the big indicators, not just small caps, is the energy sector. So again, where do we see this going? 75, 73. That is this line right here. And you can see that's been a fairly strong level of support. Realistically, it could break down here into the level of 70. And now you're talking at this point, this becomes a massive topping pattern where people bought into the energy markets post-pandemic. And then you've seen the big players just steadily dumping across this top line here, right around 90. Makes perfect sense. The energy sector, the big players know when to sell, they know when to buy. This could actually even get down into the 50s if demand from the economy is zapped enough. Would be a big opportunity, but not yet for today. How about bank stocks? Well, what did we hear? This was a big opportunity, and we said, no, don't buy bank stocks either. That's not where you want to be. Momentum clearly negative. RSI is at 24. MACD negative cross. We can see this across the board. But we told our subscribers, don't touch this a couple of days ago when the sell signal flashed to a buy, and sure enough, we nailed it. We said machines were likely to sell here. Price was coming down. Let's take a look at XLF. We see more pain here for the financial sector. Let's zoom back into that 2-year chart, and what do we see? Major support 41.10 is where the last line of buying support is at, and looks like based on the volume alone, if bank stocks are going to get there, because keep in mind, why do you see banks selling off during a recession? Because when people lose their job, they don't pay their bills. Don't pay your bills, well, that means you default. Who's on the hook? You got it, the bank. And that's the risk here of why you don't want to be in bank stocks when you're facing an all-out recession, even worse, a crisis, potential depression here. But how about Brazilian stocks? Well, we made money on that, and we didn't get back in it either. A lot of people said this is where you want to be. We said, well, maybe not. And when you now start to see the CTA position on foreign equities, you can better believe maybe not where you want to be. RSI 37, MACD negative cross, downside target now 22.26. What are we modeling? Machine selling on those long positions, just like Goldman is suggesting here that the CTAs could start dumping foreign equities. Sure enough, let's zoom in, and what do we see? A hard move down on Friday. You can see it rallied up, hit its 200-day moving average, pulled back, and now it's looking to come down. Major support again down here. There's a volume profile line at 22.26. It's hard for me to think it doesn't get down there, but let's continue on because we've got gold to talk about too. But how about emerging markets? What did we hear from the pros? You gotta buy EEM, and we said no. And sure enough, what do we see? Machine selling starting to hit here. Momentum was already negative. We said don't buy this, told our subscribers this is not what you want. In fact, we have our subscribers positioned in things that are going up, which is just a testament of being in the right side of the market and having the right tools. We give them to you each and every day. Support for EEM right here, 39.58 on the 2-year chart. You see this shaded line here? This is the zone of doom. It's actually Steve's line of doom. You break this. This is something I haven't explained, I think, in a show before. We'll take a look. Let's zoom out to the weekly. You break this line here, this shaded line, and this is when you go into an all-out crisis. You want to buy EEM, you want to buy leverage or those things, well, you got to wait. This isn't the time. And right now, you look at the long weekly chart, it's breaking below that volume profile line, suggesting people are going to be net sellers. So again, a lot of selling coming into next week. But what do we see from B of A? Buy bonds. Well, sure enough, our subscribers bought bonds. We're putting a stop loss level now on our TLT position. We're still not in the black, but we're likely going to get there. Machine positioning long, based on what Goldman had to say. Machines are going to be buyers here. Momentum's turning up. We told our subscribers you want to be the long bond, and sure enough, we see our CTA Time Pro subscribers are definitely the long bond, and you want to get in on that too. Let's take a look. Let's zoom in here to the 1-year chart. We've got a bit of tailwind behind us in terms of support, but you saw on the previous chart, let's zoom out. You've got a little overhead resistance here. This breaks out. You're going to see that quick move right up to 100. That's going to be a big money maker while the markets melt down. Put money in our subscribers' pockets and then give them opportunity to get back in. How about gold? What do you think? Does gold rally here? Does gold sell off? Are people panicking? Let's take a look, because you've got 19 consecutive daily buy signals. So right now, momentum massively positive. Pull back from its all-time high a bit, but let's take a look at the charts. What do we see with GLD? Well, right now, doesn't give us a clear picture at all. So people will probably be looking to gold, but if it does pull back to the 50-day and hold, that is your potential buying opportunity. Let's skip GDX because it's headed down, but let's talk about what people are willing to pay for imports, and that's about the dollar here, because right now the dollar's been on a downtrend. Momentum's negative. RSI is at 41. MACD negative cross. We said don't trade the dollar. We think it's going down, but right now it's got a counter trend rally. Does it stick? Does it reverse? 25 consecutive daily sell signals on the UUP. Again, we told our subscribers this is not where you want to be. We did have our subscribers, however, positioned correctly ahead of the downturn. And let's take a look at this 2-year chart. It came down, hit 2-year support. Buyers stepped in, drove price up. But here's the risk. Let's zoom into the 1-year chart. What do you see? This little red line coming down? That's a 21-day simple moving average acting as overhead resistance. So if the dollar runs up into that orange line being the 9-day moving average and gets rejected there, look for the more pain from the dollar. And if more pain from the dollar comes, it means there's more pain for the equity markets to come as well. But again, you can grab the links in the description below. Use the coupon codes for your free 30-day free trial. You can be on the right side of this market and get the right timing of when to get back in. With that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. And watch out for Monday. It could get ugly. Bye now.